Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, retirement planning, and everything related to growing your wealth. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 850,000 reads and 53,000 likes. I've produced over 800 videos with more than 350,000 watch hours as of February 2025. Today, we're diving deep into a surprising analyst move. CGS International downgrading Singtel to hold, despite raising its target price to $400. Let's unpack what this means for Singaporean investors and why this might be a critical moment to rethink your position in this telecom giant. First, let's set the stage. Singtel is Singapore's largest telecommunications company, with a market cap of over $60 billion. It's a household name, providing mobile, broadband, and enterprise solutions locally, while also holding strategic stakes in regional players like Bharti Airtel in India and Optus in Australia. Over the past year, Singtel's share price has climbed nearly 15%, outperforming the Straits Times Index. But last week, CGS International dropped a bombshell. They downgraded Singtel from add to hold, while paradoxically increasing the target price from $3.75 to $400. Confused? Let's break it down. The downgrade paradox. Why hold with a higher target? CGS International's move seems contradictory at first glance. If they're raising the target price, why downgrade? The answer lies in valuation ceilings and market timing. Singtel is currently trading at $3.90, just 2.5% below the new target. Historically, Singtel's forward PE ratio has hovered around 22x, and right now, it's sitting at 22.2x for FY 2026, which is +1 standard deviation above its 10-year average. Translation: the stock is priced for perfection. CGS believes the recent rally driven by a flight to safety during global trade tensions has left little room for further upside. But here's the twist. The target price hike reflects hidden value in Singtel's associates, particularly Bharti Airtel. Bharti's shares have surged 18% year-to-date, boosting Singtel's net asset value. Singtel plans to reduce its Bharti stake from 29% to 24%, potentially unlocking $8 billion in value over time. For every Rs100,000 share increase in Bharti's price, Singtel's target price rises by $0.12. This creates a tantalizing wait-and-see scenario. If Bharti keeps climbing, Singtel could breach that $400 ceiling. But for now, CGS thinks the easy money has been made. Financials: strong earnings, but is it enough? Singtel's upcoming Q4 FY 2025 results, due May 22nd, are expected to show 11.3% year-on-year core net profit growth to $2.5 billion. EBITDA and EBIT are projected to rise 6.2% and 19.7%, respectively, driven by cost-cutting and improved margins in Singapore and Australia. Dividends also look sturdy, a final payout of 6.9 cents per share, representing an 82% payout ratio, and a 4.2 cent value realization dividend from asset sales, totaling 16.7 cents for FY 2025. That's a 4.9% yield at current prices, a key reason CGS thinks the stock has downside support. But here's where I disagree slightly with the analysts. Singtel's dividend payout ratio hit 328% in 2024, largely due to one-time asset sales. While the value realization dividend is a nice bonus, it's not sustainable long-term. Investors banking on steady income should watch Optus' performance in Australia and whether Singtel can maintain its $200 million annual cost savings. The Bharti Wildcard and strategic shifts. Singtel's fate is increasingly tied to Bharti Airtel, which contributes over 40% of its associate profits. Bharti's dominance in India's telecom market, where it's battling Reliance Jio, makes it a cash cow, but also a geopolitical risk. If India's regulatory environment sours or competition intensifies, Singtel's revalued net asset value could take a hit. Meanwhile, Singtel is pivoting to data centers and cybersecurity, a smart move, given Singapore's push to become a digital hub. The government's 5G rollout, led by Singtel and StarHub, and new data center investments could offset slower growth in traditional telecom services. But these ventures require heavy capital expenditure, and Singtel's net debt remains elevated at $14 billion. Singaporean context, CPF, taxes, and sector trends. For retail investors, Singtel's appeal lies in its eligibility for CPF/SRS investments and its status as a blue-chip dividend stock. However, Singapore's new 15% minimum corporate tax, effective 2025, could pressure Singtel's offshore earnings, particularly from lower tax markets like India. On the flip side, Singtel's ESG initiatives, like its net zero by 2045 target, might attract sustainability-focused funds. Looking at the broader sector, UOB Kay Hian forecasts 80% year-on-year earnings growth for Singaporean telcos in 2025, driven by enterprise solutions and cost discipline. Singtel's rivals, StarHub and M1, are also doubling down on cybersecurity and managed services. But Singtel's scale and regional diversification give it an edge if it can navigate the valuation tightrope. My take: hold but stay alert for catalysts. CGS International's hold rating makes sense tactically, but I'd add two caveats. First, Bharti's momentum could defy expectations. India's stock market is booming, and Bharti's 5G rollout might fuel further upside. Second, Singtel's $12 billion asset monetization pipeline, including Comcentra's redevelopment, could surprise to the upside. If management accelerates stake sales or partners with global data center operators, the stock might re-rate. That said, Singapore's telecom sector is maturing. With 162% mobile penetration and 5G adoption plateauing, organic growth is limited. Singtel needs to execute perfectly on its digital pivot to justify its premium valuation. If you're finding this analysis valuable, imagine the level of detail you'll get with our daily premium content. For just $1 a month, you can become a member and unlock exclusive insights, deeper dives, and more to help you navigate the Singaporean investment landscape. Don't miss out on this opportunity to level up your investing journey. The link to join is in the description below. Key takeaways: Singtel's hold rating reflects valuation ceilings, not weak fundamentals. Bharti Airtel's performance and asset sales are critical to unlocking upside. Dividends at 4.9% yield provide a safety net, but payout sustainability is a watch point. Data centers and cybersecurity are long-term growth drivers, if executed well. In short, hold tight, but keep your eyes peeled for Bharti's moves and management's next steps.